Welcome, everyone, and thanks for taking the time out this morning to listen to the webinar, the High Street webinar on the Global Balance Fund. I'm Mike Patchitt, the Chief Officer of High Street Asset Management. On my right, we've got Ross Beckley and Ross Yammin, who are going to be part of the presentation. What we're going to do is start off by going through the performance review of 2022, highlighting the positives and the negatives of last year, moving on to the protection strategies that we used in 2022 and why we have substituted the protection strategy moving into 2023 to increase our exposure in fixed income. We're going to go through the equity and property portion of the portfolio and why we underperformed in the growth element of the portfolio last year, and the property portion of the portfolio which underperformed quite significantly in 2022. Then we're going to move on to our current exposure in fixed income, and then the outlook for 2023 and beyond, showing what we think is a great start to 2023. 2022 was a very tough year for global indices. Not only was the MSCI World Index down 19.5%, but as you can see, the S&P down 19.4%, the developed property market internationally down 25%, which is quite significant. And on top of that, corporate bonds down 16.2%. That's against, obviously, as South Africans, the JSE All Share Index that only went down 7.3%. On the right, one thing we did get right is that the US dollar has appreciated quite significantly against most currencies, and we're quite pleasing that we concentrated on dollar investments during the year of 2022. If we have a look at, this is the performance of the green line being the performance of the High Street Global Balance Fund since inception. We started the fund in 2011. We listed it in 2015. And as you can see, 2021 was, we started underperforming, and the majority of that was our exposure to China, which we have subsequently closed. But if we have a look at 2022, our benchmark, which is in the green line, was down 20.2%, and we did minus 18.7%. So we slightly outperformed the index during the year of 2022. Over to Ross Beckley to carry on the attribution.
Yeah, thank you, Mike. Speaking to that performance, while we did slightly outperform the benchmark, it was still a disappointing year for us. The balanced fund mandate is to capture approximately 80% of the upside, whilst only enduring 50% of the downside. So we would have communicated to clients throughout the years that we aim to use protection strategies to mitigate large drawdowns. And you can see on the far left that the hedging strategies that we had in place last year were very, very positive for the fund, generating a return of 9.6%. However, that was largely offset by a very poor showing from equity, and notably a poor showing from our listed property exposure. Our listed property detracted 10% from the fund. This has to be put into some context. We went into the year with a 20% property exposure, so our property really got hit hard, and we'll dive into the details later to ascertain why and what value we see going forward. Likewise, our equity performed poorly, and that was largely due to having a bias towards the growth style, which also performed poorly in light of elevated levels of inflation and interest rate hiking interest rate hikes coming through. First, we can speak to the protection strategies, which was, as I mentioned, a net positive for the fund. The charts here show our positioning as of June last year, which we discussed. We were very defensively positioned to protect against a market drawdown in the magnitude of 10 to 20%. What we saw from that date up until the day which we closed the hedging position was that the market came off some 10%. So the fund benefited very nicely during this period with the protection instruments kicking in and working very nicely. So what have we done since then? We've actually decided not to roll, to elongate the hedging structure, but instead we've left the fund unhedged from a protection standpoint. Why have we done this? Looking at the MSCI All Country World Index going back some 50 years, we can see that 2 consecutive negative years is very, very rare. And this has only happened on 3 occasions going back 50 years. As a result, we decided not to reinstitute the hedging policy, as we think the market is offering some value at these levels. Instead, what we've done to balance the fund in line with its mandate is to increase our fixed income component. As we'll detail later, we had approximately 0%, a 0% exposure for about 5 years, and then have recently added, lifting that up to 18% towards the end of last year. So you would have heard a lot of concern around the markets, and for a lot of it for good reason. The concern surrounding rising interest rates. Are they a concern? Are they a reason to stay out of the market? What we did was we had a look at past rate hiking cycles going back 50 years, and we can see that on the 8 occasions during these cycles, there was actually pretty positive performance for the markets going ahead 1, 3, and 5 years, notably from the NASDAQ, which is a growth biased index relative to the S&P 500. So looking at the average across those occasions, we can see that during a rate hiking cycle, markets actually go up, with the NASDAQ up some 10% on average and the NASDAQ 26%. Looking at the 1-year numbers, pretty flat returns. However, if we go forward 3 years following the initiation of a rate hiking cycle and 5 years following the initiation of the cycle, the equity markets produced positive returns. Interestingly, the current cycle which we are in, when they began raising rates 1 year ago, we can see that the S&P has come off 14% since then, and the NASDAQ 26% since then. So simply using history as a guide, it tells us that the market is at a relatively low level here. Clearly, the fundamentals matter more. We can't just look at price. We are a fundamental house, and we'll dig into this a bit later on the attractiveness of the fundamentals which we see at these levels. Yes, interest rates may affect valuation in the short term, but in the long term, it's all about the cash generating capabilities of these companies. Just as an aside, on the right, you'll see the S&P 500 forward price to earnings ratio. Unfortunately, the data only goes back to 1990, but I think the point is still valid there. We are around about the historical average of 17.4, and those green bars there indicate rate hiking cycles and what the PE ratio did. So there wasn't this huge sell-off in markets reflected in lower PEs. You can see that the PE ratio held relatively steady during those periods. So the market likes to concern itself about a lot of factors. There's always talk. There's a lot of noise in the markets. And concern, especially towards the end of last year, centered around economic growth concerns. And what was the market going to do if GDP came off or contracted? So what we did there was we completed the same exercise, but instead of focusing on interest rates, we focused on GDP growth, and in this case, GDP contraction. So you can see on the left quadrant there, that is the performance of the S&P and the NASDAQ during the year of economic contraction. And generally, you can look at those gray squares in the middle, with the NASDAQ having done with the S&P 500 having done 2% on average, and the NASDAQ positive 13. If we move forward and we look over a period of 3 years, pleasingly, the averages increase pretty significantly. And important to note there is that the NASDAQ, the lowest return over the subsequent 3-year period, has been flat, whilst the highest return has been 108%, with the average at 39. Then over 5 years, the picture looks even better, especially for the growth-heavy NASDAQ as opposed to the S&P 500. So what does this tell you? The markets are forward-looking, typically 6 to 9 months. And when we find ourselves in a recession, the market has usually priced that in already. So moving on to our equity performance. My apologies. To sum up with our protection strategy, we believe the market has already come off quite a bit. Yes, it's recovered in recent time. However, we are seeing value here, as shown by our models, which uses a bottom-up approach to evaluating stocks, and it is suggesting decent upside from these levels. So we don't feel it necessary to roll the hedging structure, but we'll keep a pretty large component of the fund in bonds to diversify the risk return profile. Moving on to equity. Equity, as mentioned, performed poorly, and we can see why. It's in very stark contrast, the traditional value shares versus the growth shares on the right. So if we go far to the right, we can see Meta Platforms, Nvidia, even Amazon, these big tech companies, sold off sharply. On the left-hand side, we have the more value-orientated shares and cyclical shares in the names of Merck, BHP, AbbVie, actually generated very, very strong returns. So we can see that the NASDAQ was down 33% last year. Once again, growth-heavy NASDAQ, whereas the S&P 500 was down 19%, which has more of a value tilt as opposed to that NASDAQ index. Going into the year, we had about 65 to 70% exposure to the growth style within our equity component, and as such, this led to a poor performance, especially relative to the S&P 500. So the perennial debate is growth or value. Looking back over the past 10 years, growth has outperformed value quite significantly, despite the sell-off that we've seen in growth versus value over the past year. So over the past year, you can see that growth outperformed value to the tune of approximately 23%. That is the second largest outperformance of growth versus value on record, going back to 1971. And this was all around fears of those rising rates. However, in previous slides, as I've shown, typically rising rates do not necessarily mean lower future market returns. So we've spoken a lot about price and the price action. Prices are going to move a lot based on sentiment around which we have no control. Where we do have some degree of control is on analyzing the fundamentals of the companies in which we invest. So just looking from a broad index level, we can see the S&P 500 on the left. During the course of 2022, to date, the change in earnings per share forecasts, as per consensus analysts, was for an increase of 3.1%. Important to note is that these forecasts are typically 3 to 5 years out. So we can see that analysts have re-rated their earnings per share forecasts up. The price of these stocks of the S&P 500 came off 10.3%. So the fundamentals outperformed the price by some 13%. While still underperforming, this was a lot narrower than what was recorded in the NASDAQ composite, with the price coming down 33%, whereas the earnings per share forecast only coming down 5.9%, which is a differential of 27%. So we have a differential of 27% playing against 13% on the S&P 500. So does that mean that stocks within the NASDAQ were just significantly overvalued 1 year ago? Or is opportunity being presented at these levels? We think it lies somewhere in between, but closer towards opportunity. And that is evident in our upside potential that we see going forward. For the S&P 500, our upside, projected upside is 4.2%. That is an annualized figure over the next 5 years. So not a fantastic return on the S&P 500 as a whole. Whereas if we look at the NASDAQ, we are forecasting a return of 9.5% per annum over the next 5 years. Analysts tend to agree with them seeing close to 10% upside over the next 12 months on the S&P 500, whereas on the NASDAQ, they see close to 14% upside.
So Ross just finished with the equity component, where he's highlighted a big discrepancy between the underlying performance of the businesses that we own and the extent to which they have sold off during the year 2022. Property stocks, and particularly our property stocks in 2022, sold off very hard as well, having a big negative effect on the fund. But again, in a similar sort of fashion, what we saw within our property holdings was a big dislocation between the underlying company's business performance and the share prices that we saw come off quite drastically. So if first I can address the fundamentals, and then on the next slide we'll jump to the extent to which they sold off and why that was the case. So in terms of 2022, what did we see in amongst our basket of property stocks? We saw, in terms of rental income, we saw the rent per square actually increase and increase quite dramatically for some of our bigger weightings. Whilst occupancies and rental collection rates stayed largely stable with those companies' histories. Some of our companies have rent collections and occupancies well above 90%. And so from a rental income perspective, we've seen some really stable performance from our holdings in the year 2022. When we are screening property stocks and we're looking across the universe at what we find attractive, what is of crucial importance to us is the strength of our property companies' balance sheets. At the moment, the weighted average loan to value of our property companies is at 36%, a level which we would imagine would be quite a lot lower than what would be in a developed market property index. We don't want our property companies to be having too high a cost of debt, and our property companies within our portfolio have a cost of debt which is lower than 2.5%. We look for our companies to have a 90% or more of their debt fixed, with the maturity of that debt being 3 years plus. Again, for some of our holdings, we're seeing maturities of 4.5 to 5 years as well. So from a fundamental perspective, exiting the year 2020, we were quite pleased with the way our property companies performed from their underlying businesses perspective. But despite that, and as Ross, if you can go on to the next slide, they sold off pretty drastically for a lot of the reasons which are similar to what Ross has spoken to regarding the equity component. But what is exciting to us is when we go back towards history, And we have a look at some previous drawdowns. The most recent one in memory is the 2020 drawdown, which occurred due to the rise of COVID lockdowns. What we saw is that the developed market property index fell 43.1% from its highs. It fell so really, really quickly. And we saw the high street property component fall 44.7%. What's encouraging here is that post that big drawdown, it took the index 17.1 months to recover all of those losses. Meanwhile, our property component, which is made up of very similar stocks today, it only took us 18.4 months, so 8.4 months to recover that loss of 44.7%. In 2022, we did see big drawdowns. We saw a 32.5% drawdown from the developed market property index, and we saw a 41% drawdown from our property component. And how long is it going to take us to recover? We would imagine that it would take us to the high street basket to recover a shorter period of time than would be the case from the developed market property index. We did some work yesterday on this, and so far, just in 2023 alone, our property component has recovered 30% of that 41.1% loss already. Meanwhile, the developed market property index has already recovered 44.5%. So we would imagine we are going to recover those losses faster should we see a prolonged risk-on environment, as we have seen at the beginning of 2023. And we remain steadfast in the fundamental performance of our property component.
Yeah, I think Ross has covered it very nicely there. In simple terms, we look for property companies that can generate a yield on their properties in excess of their funding costs. And Ross mentioned on the previous slide that the cost of debt is relatively low and it's fixed some 90% 4 years out. So we believe that these property companies continue to increase their rentals, which is a sign of strength. They can push through these onto clients and push through inflation, and yet the cost of their balance sheet remains quite low. So in the short term, we've seen a very negative reaction to interest rates, but over the long term, the listed property market is more correlated with GDP and inflation as opposed to interest rates.
I think, Ross, if maybe I can just give an example. So our worst performing property stock of last year was Sirius. Sirius is a company we know well and which has been a core component of our property component for a very long time. Sirius fell more than 50% last year in terms of its share price. But despite that, it pulled in rent per squares, which increased about 4% across the group. It had occupancies in line with history at about 85%. Rental collections sat well above 90%, with an LTV of 42% and an average cost of debt of 1.3. If we have a look at the terms of that debt, 97% of Sirius's debt is fixed. So these drastic rate increases, which we've seen happen in the last year, should affect them to a lower degree than it would somebody who had a greater portion of floating debt. And only 13% of their debt is expiring within the next 3 years. So the business is in a very strong fundamental position, but there was a dislocation between what we saw from the underlying performance of the business and the share price.
Thanks, moving on to fixed income, a component which we are finally excited about. Going on the top left chart, we can see the returns of the corporate bonds, of the corporate bond index going back some 30 years. You can see that generally property has been pretty defensive, living up to its name as the asset class that is pretty defensive in nature. However, what we saw last year was a very big correction when compared to losses incurred in previous years. So we had a loss of approximately 18% on the bond index, which going into 2022, I think if you had told market participants that they would get an 18% loss on their defensive bond positions, many would have laughed that off. So interest rates have been in a downward cycle since 1980 until recently, last year, 12 months ago. Then we saw interest rates starting to tick up, and because they were coming off such a low base, bonds have a very at that stage had a very high sensitivity to changes in interest rates. So the capital value of your bonds really sold off sharply. However, at these levels, we are starting to get a little bit excited. And as such, we've increased our bond exposure to, as mentioned, 18%. Looking at the chart on the bottom left, you will know that inflation and interest rates are very closely correlated with a bit of a lag effect. These are the inflation and interest rate numbers in the United States going back to 2014. So we can see, first looking at the navy line, interest rates have been close to zero following the ramifications of the global financial crisis. There was a stage where they attempted to raise rates, but had to take their foot off the accelerator, and they dropped back to zero. There you can see the rapid incline. It is the most rapid interest rate hiking cycle on record, and that is to tame high levels of inflation, which have ensued following years and years of loose monetary policy, exacerbated by the invasion of Ukraine, which sent energy prices soaring. However, what do we see going forward? Going forward, we and the market sees interest rates as having peaked or nearly peaked and then easing. Just last night, we saw Jerome Powell coming out saying that interest rates are probably going to come off in 2023. The market reacted very positively, especially a lot of the growth names which we hold. But back to the fixed income component. If we look at the scenario analysis on the right-hand side, because we are not macroeconomists, so we don't try and forecast these things. We literally assess the probabilities of price action depending on where things can go. And if there's a margin of safety incorporated in there, then we get excited. So if interest rates were to remain at these levels through to the end of 2024, that is our base case. And that is what the market is seeing as well. We would have a 4.5% return per annum from the interest paid on those bonds. The capital return would be marginally positive, giving you a total return of 5.2% per annum. Now, this is not too far away from aligning itself with our mandate. The mandate of the fund is to produce US CPI plus 3 to 5%. Yes, CPI is at extreme levels at the moment, around 7%. However, we do see this coming off on the back of their aggressive interest rate hiking policy. So first, we have to consider what is the downside. If interest rates remain stubbornly high at these levels and actually increase a little bit further to 5.35%, you'll see there that historically speaking, this is towards the upper end of their range. And central banks simply cannot afford for interest rates to remain this high. Solvency and solvency concerns become an issue due to the large amount of debt which they have issued over the past 2 decades. So even under this bear case, we expect to generate a total return of 2% per annum, with that divided by the components divided between a 4.5% interest return and a capital detraction of 2.5% per annum. So a return of 2% on the downside, 2% per annum on the downside, is still assisting the fund in achieving its mandate, especially from a volatility standpoint, as increasing this component decreases the overall fund volatility. However, if we have to get bullish, we can see that the expected total return is 10.9% per annum. Now, I'm sure any of you would, especially investors in this fund with with this specific risk return profile, would be very happy with an annualized return of 10.9% over the next 2 years. And you'll see there that the capital return component of that is 6.4%. Mike, do you want to take the outlook?
Yeah, I think, given what's happened in 2022, when, we think inflation peaked towards the end of 2022, obviously with COVID coming to an end and reopening in China, we think there's going to be a stimulus. And, I think the Russian-Ukraine conflict could go on for some time into 2023. But certainly, if we look forward to 2023, we see both inflation and interest rates easing, which is good for growth stocks and good for the bond portion of our portfolio. Obviously, growth being a major portion of our portfolio, and the property fundamentals remaining resilient, which will support certainly our shareholding in the property stocks that we hold. So fairly positive going forward, given a lot of uncertainty, but certainly seeing what the equity market has done over the last, during 2022, we certainly are very positive with our asset allocation within the fund.
And you'll see there that the two most notable factors are, firstly, the increase in bond exposure from 0 up to 17%, seeking to take advantage of the opportunity which we see in the market at the moment, as well as, if you set your eyes to the left, there will be our equity exposure. Now, having not decided to renew our protection strategy, this has increased our equity exposure within the fund. And as Mike mentioned, with inflation and interest rates set to ease and come off, we are positive on the space, especially the growth assets.
Ross, before you move on, I think the other big difference there is in the column to your furthest right, when we have a look at the cash component. Last year, the US dollar performed incredibly well, and the majority of the cash which we held was in US dollars. So that would have been beneficial to fund performance in 2022. And having not reinstituted the hedging strategies, it does allow us to hold a lot less cash and to allocate that towards places like fixed income or potentially some more growth equities where we see value.
Fantastic, yeah. And then we know last year was a very difficult year for all investors, our investors included. We spoke to how our equity got hit particularly hard, as well as our property. The year is still young. We are only, 5 weeks through the year. However, there's been a very positive story that's emanated out of our equity. So we can see that on the top left, the growth equity component of the fund has generated a return of 17.55% year to date. This compares to a return of minus 22% last year. So things seem to be turning around there. And importantly, if you look on the top right, defensive equity has been pretty flat this year. So that rotation out of value back into growth seems to be happening at the stage. And we think there's still wind in the sails that can continue this trend going forward. Likewise, our property exposure on the bottom left really performed poorly last year, primarily due to the focus being on small to medium-sized property companies, which got sold off particularly hard. We can see we are down 38% on that component. However, year to date, we are up 17.4%. So very strong showing from the two laggard components within the fund. This translates to a strong fund performance year to date, with the fund being up as of today 11.6% versus the benchmark of 6.32. As mentioned, last year we outperformed the benchmark slightly, but we're still disappointed with the results given the protection strategies we had in place, ensuring that we only want to capture about approximately 50% of the downside. So it's been a great start to the year. We are positive on the markets. Inflation being the key determinants of what happens going forward. We can see how sensitive the market reactions are to Jerome Powell's every word. So we'll be watching that carefully. However, I think important to note is we are not macroeconomists. All we can do within our control is to focus on the fundamentals, and the fundamentals seem strong, and the market is rewarding these companies so far this year. I don't know if you have anything further to add.
I think that's just about covers the whole presentation. I don't know, are there questions? Are they, how do we do questions?
Yeah, let's have a look here.
If we move to questions and answers.
Sorry, let me call the technical team in.
There's one question. I see there is one question. Okay. Right. I think the question is, would you invest in gold? My answer to that is no. I think, we look at total return, which includes yield, and certainly yield. Gold offers us no yield. And given the uncertainties over the last 2 years, we haven't seen gold appreciate much, despite a lot of uncertainty in the market. And, in the long term, we still think growth is where we're going to get the best return. So at this stage of the game, if we can get a yield on bonds with very little downside, we certainly prefer bonds to gold at this stage.
Yeah, I think just to add to that, Mike, gold was always seen as a safe haven, a store of value in uncertain times, as well as a store of value during inflationary times. We have seen both of those occurrences over the past 2 years, and yet the gold price is up, but it's not significantly up. So both of those, of the two, I'd say, major factors meant to be driving the gold price aren't there. As a store against inflation, we would rather invest in property, especially the property which is able to pass on top-line rental increases to their tenants, and thus secure a higher cash flow from that.
Close it, and then there's another. Is that it?
Okay.
There's another one. Is big tech still a good place to be? Certainly, I think big tech is a great opportunity. It's come off sharply and still growing enormously. And certainly it's a major weighting in our portfolios, and is what our growth is all about. So big tech certainly is a big element of our portfolio, yes.
I think Ross spoke to this a little bit earlier. If we use history as a guide and we go back to previous times of uncertainty, whether that be related to GDP growth or related to interest rate hikes, what we've seen is that the tech-heavy NASDAQ has outperformed the S&P 500, especially over slightly longer periods of time. That tech-heavy NASDAQ is obviously driven to a large extent by a lot of these big tech type companies, your FANG plus type companies. And so they would have been responsible for quite a lot of that outperformance in previous times of uncertainty. So, I would suggest that we think, yes, big tech is one of the places to be at this point in time.
And I think that's evident in Meta.
Yeah.
What we've seen over the past 3 months is astonishing performance out of Meta. What's it up from its lows? It's almost up 70-80% from its lows. Yes, it was battered. However, the fundamentals look, I would say, decent, not fantastic. However, there's a lot of cost cutting going on in these big tech companies to improve the bottom line and ultimately cash flows. And that's what we as investors are after.
And certainly the big techs are full of cash. They've got good balance sheets and can spend money and get the returns over the long term.
Yeah, I think Ross's point there is very valid. I think a lot of these big tech companies for the last 10 or 12 years have been on spending sprees, probably spending beyond what they should have been, and probably not behaving in the most disciplined manner. And I think what we've seen on every call that we've followed up on in recent months is to see that these guys are really cutting costs heavily, trying to look after the margins, which are very impressive, particularly from the bigger guys. And so I think that time of exuberance is largely over. And as we've seen with Meta, hopefully as these guys cut the costs, we can see their share prices react to a slightly more disciplined approach for the big tech guys going forward.
Okay, should we just give another 10 seconds to see if any questions come through?
But certainly, sorry we took quite a lot of your time, but hopefully we've covered history, current, and a view on looking forward. And thank you very much for your time.